Hi, everyone. Thanks so much for joining us today. Just wanted to let you know that we will be getting started shortly. Well, hello again, everyone, and thanks so much for joining us for today's Bend Young Professionals Expert webinar. My name is Hannah Terrell, and I am a People and Culture Specialist at Thump Coffee, and I'm connected to Bend YP. I've been working with Bend YP for a couple of years, and right now I am the Vice Chair of our Advisory Council. Before we get started, I wanted to bring up that our summit is coming up, and this year it's really exciting because we have two options for you. There is a in-person and a virtual option so that everyone can choose something that makes them feel safe, and it is on August 28th. So if you would like some more details on that, you can check out the link that will be posted in the chat. Our focus is going to be resiliency and relationships and results. We have 3 R's, and we're so excited to get to present that to the community. So let's go ahead and get started in the content. Today's webinar is all about money and financial planning, and I'm really excited myself just to sit and learn too. We are joined by Kyle Frick, who is the VP of Marketing at Mid-Oregon Credit Union, and JC Hallman, who is a financial advisor with UNC Mutual, and Sean Dunn, who is a mortgage specialist at Directors Mortgage. Now, before I pass it off, just a couple housekeeping things. If you have any comments, feel free to add those in the comment section, and any questions can be added in the Q&A. And we'll also send some slides in the recording in a follow-up email. So I'm going to go ahead and pass it off now to Kyle.
Thank you, Hannah. Appreciate you hosting this today, and thanks to Madeline and JC and Sean and all of you for being part of this. We really enjoy being here and sharing this information. So I'm going to get my screen up here, and then I can start. But while I'm getting that fired up, should be, how come it's not going to, there we go. I think it was working before. Sorry, let's go, it should be like that one. And then I have to go back. Why did I want to start there? I'll get it figured out here. There you go. Sorry about that. Thought I had it in the right place to start out with. Just wanted to share a little bit about Mid-Oregon Credit Union. We're a credit union here in Central Oregon. We were started in Prineville in 1957. We have over 37,000 members here with branches in Bend, Redmond, Prineville, Lapine, Sisters, and Madras. And so we're in all of the major communities here in Central Oregon, and this is where we spend our time and work with the communities to build Central Oregon into a better place. So understanding credit, we are a credit union, so we try to share people and help people understand and how to use credit wisely. And I love the tagline down here, how can you afford it and how will you pay? Because that is really the basis of credit. credit used to be something that, was in, you knew people that you loaned money to, and a handshake was your bond. And in today's world with people so mobile and things like that, it's hard to understand who is, good credit risks and who aren't. So credit scores and understanding credit is a great way for us to be able to, let people know, where they're at and how that they can manage that. And so that's the big part of it. It's not really difficult, but it is, if you're knowledgeable about credit, you can either make credit work for you or you will work for credit. So that's kind of the thing we focus on is, just making sure that people understand it, can use it wisely. It's a tool, and it can save you a lot of money if you're using it wisely. So what is credit? It's the money that you borrow to buy things when you need them, and then you agree to pay it back and at an agreed time and with applicable finance charges. So there's a cost to borrowing money, and that's important to understand, because if you're a high credit risk, it costs you more to borrow than it is if you are a low credit risk. There's really 4 different types of credit. The first 2, charge cards and accounts, or charge cards and revolving credit, are relatively the same. You borrow money and then you pay back a portion of it every month. It's a revolving credit line. And so just like a credit card, you can pay your whole credit card off every month, or you can pay a portion of it off and pay it off over time. Installment credit is, when you agree to pay a certain amount for a certain number of months, like a car loan or a home loan. And then we also have, as probably everybody is familiar now with all the different types of services that we really use, but service contracts include things like your power bill, your water bill, and your phone bill, and then things like Hulu or Netflix or Amazon, things, again, that you have a monthly payment schedule for those services that you receive. Advantages and disadvantages, certainly credit makes it much more easy to purchase things. It's convenient. You don't have to have cash on hand, and you can actually keep track of things that way and manage them. The disadvantages, as outlined, it is a loan. The rates could change. It could go up or they can go down. That's what we've seen recently, is more rates going down than up. But they could include fees. It can be easy to get behind and overspend. And it doesn't often, having credit and being able to buy something right now, the impulse buying thing is a real thing. And a lot of people aren't very good at managing that. And certainly credit card companies are aware of that and like those type of people that are buying on impulse. Why is credit important? It just impacts all areas of your life. There's just some things you just can't do without credit. Like, you can't purchase an airline ticket with cash. You can't rent a car with cash. You can't do a lot of things with cash that you can do with a credit card. And so it's important to have good credit and manage that credit and maintain it. And it's also, really important for you over the long term to not to pay less than more by having good credit. Excuse me. So this slide is basically, yes, everybody needs to build good credit because it's something that is essential if you want to participate in the broader community in a lot of different ways. And so just knowing how to manage it and how to, what the scores mean and how we can utilize those and how we can get back on track if we get off is really important for a lot of people. Credit is managed through really 3 reporting agencies, and they connect together as well. So different organizations may report to one credit reporting agency or another, but they share information and also allow for just, you can get the credit scores from individual reporting agencies, or you can get all 3 through the annualcreditreport.com. And one of the things, if you want to do it for free, there's a couple different ways you can do that. There's other online websites like creditkarma.com, and just recently with our new online banking upgrade, we have Credit Savvy built right in where people can see their credit score inside of our online banking and update it and see all the information. It's a great tool to be able to see and manage your credit and know where you're at any given time, and then to keep track of things that are going on and off your credit record and being able to make good decisions based on what you see there. What's in a credit report? There's lots of really good things in a credit report, but just information about you, key information, your name, social security number, your address, those types of things, you know, the common things that you would find. The job history, you'll find that there. Your creditors and your payment history is a really big one. Having a long credit history and paying your bills on time are really important things, and understanding how much capacity you have. All of those things are important. We'll get to those. What kind of legal actions have you been in a foreclosure? Are you are you in collections? Do you have outstanding debts that you haven't paid? And things like that are pretty good to know. And other inquiries you've initiated. For example, if you want to purchase a loan, or you want to purchase a car, then when you apply for credit for a car, that goes on your record. If you go out and do an application at 7 different dealers for 7 different cars, then that starts to look a little bit funny on your credit report, and the formula for that actually starts impacting your credit score. So just things you need to know so that you can protect yourself from your score. FICO, and that's the first big thing, is FICO, is Fair Isaac Corporation, and that was developed in 1989. They found a algorithm that determines your score by these different criteria. And as you can see, your payment history, or paying your bills on time, is 35%. That's the biggest part. And the amounts you owe is 30%. So those two are 65% of your total credit score. And so you can impact that pretty significantly just by adjusting those two things and making a difference in your credit score. Then you have 10% for new credit, 15% for your length of credit history, and then your credit mix, which goes to how much revolving credit you have, and installment loans and things like that. So there's also good credit and bad credit. If you're borrowing from a finance company, for example, versus a bank or credit union, that has a different look on impact on your score. A lot of times, if you're borrowing from last resort lenders, payday loans and things like that are showing that you're utilizing credit, but you're having to go and pay more for that, or because either you don't know, or you may not be able to get credit from other places. So a good thing to know. This gives you an idea of where people are at as far as the total population. And as you can see, if you look at the 800 to 850 score, and I need to back up, but the scores go from 500 or 350 all the way up to 850, 850 being the highest score. So the 800 to 850, the 750 to 799, 700 to 749 are all considered like a platinum credit, which is the very best. It means that you are low risk, you're a good borrower, you're managing your credit well. And as you can see, that's 58% of your total population have really good credit. So it's the other half of the population that has less than stellar credit, or are improving their credit or building their credit at this time. Who can look at your credit score? People who are going to loan you money. It's very important for them to know who they're lending to. And so they want to know what kind of history and background, and what the propensity is for people to pay them back if they loan them money. Landlords look at that as well, and they want to know if you're going to pay your rent on time. Insurance companies, for the same reasons as landlords and lenders, they want to know what kind of payment history you have, and if you're going to pay your bills on time. They're going to give you a policy, and they want to know if you're going to pay on that policy. And then the other one is potential employers, which again, it goes to how what's your integrity level? If you're not paying on your promises, then what does that indicate as far as your character? So that's an important thing when people look at that. Plus, it's just, if you're in a great deal of debt, and there's risks associated with that as well. So how do you establish credit? There's a list of ones here, and there's better ones than others. Borrowing money from a credit union or a bank and paying back the loan is probably the best, because you're going to get a monthly report against your credit report, and it's coming from a reputable organization that's well established. One of the things that I don't see on here that we have is a credit builder loan, which is another form for you to, if you don't have good credit or you haven't established credit yet, it's a good way to either fix your credit or get your credit started off on the right foot and give you, monthly reporting, and then help you understand how to pay a bill on a monthly basis, and then to move to the good side, which will significantly decrease your costs of borrowing money. What else do creditors consider? The character, I think we talked about. What kind of honesty and how likely you are to repay a debt. Capital, which I also call collateral. Collateral would be, what do you have that's valuable that you can put as a hold on? And for example, when you buy a car, the credit union or the bank may hold the title until you pay off the loan, and so that automobile becomes collateral for your debt. And if you don't pay your bills, then you're going to end up getting the car repossessed, and then the credit union will have, or the bank will have to sell that to recover what they can from the loan. So that's the collateral. Capital. And capacity is something that we had talked about earlier on the FICO score. Capacity is how much do you have available on your credit lines, and how well are you managing that? Credit card companies look for you to be at probably less than 25% of your total credit available. So simple numbers look like, if you have a credit card with a limit of $20 or $1,000, then you would want to maintain under $250 on that credit card at any given time. And if you do that, then your credit score continues to improve. If you have $999 borrowed on your credit card of $1,000 limit, then that starts to deteriorate your score, and because you're pressing your limits. And if you trip or stub your toe, then you end up having to go over, and then you're going to be subject to fees for overdrawing your account or going over the limit, which some people don't mind paying. I think it's a matter of, what do you want to pay for the cost of borrowing money, and that's a one that you can easily avoid if you manage it. So how do you maintain good credit? You create a plan and you work on, we like to call them spending plans rather than budgets, because you have to spend money. And so it's just how you spend your money, and paying yourself first is always important. So there's ways we can talk about that. Be consistent on your application, pay your bills on time. I can just not overemphasize, paying your bills on time really does make a difference and avoids a bunch of fees for late and all those other things. And then the next one, having some credit but not too much, goes back to the question of capacity. Just be careful to keep your balances low. Use caution when closing accounts. Beware of your debt to income ratio. How much money do you make versus how much money have you borrowed is is something that lenders will look at and important. Demonstrate stability so that you're not jumping all over the place, moving your accounts all the time, opening and closing accounts, things like that. And make sure that keep open lines of communication with your lenders. If you're having a problem, the best thing you can do is work with them. Don't stop taking their calls because it'll get worse. It's important just to stay in communication. So finding the best loan, you just want to do your shopping and check your rates and find your best options. And I'm just focus on, the dangers of excessive debt, the inability to keep up with your expenses. It causes a lot of stress. It makes it really hard for you to save for your future, and it damages your credit history. And with that, I'll say, yes, we can help you if you need help, and we have people that can walk you through things and figure out what works best for you. So thank you for listening, and I hope that was helpful, and I'll turn it over to Sean. Or JC, sorry, JC.
That's okay. I'm going to share here. And hopefully now everybody should be able to see my slides. So first, thank you very much for the opportunity to be here and to participate in this and give kind of some thoughts and ideas on how to approach retirement. And what's designed to do today is just to give some kind of high-level suggestions on what we should be looking for and what you might consider as you begin to be looking at your retirement planning. So number one, when is the question that I get a lot about. When should I start looking at retirement? And my answer is immediately, right? The longer you wait, the longer it's going to hurt. And so as you go through and you look at when are the best times to start planning in retirement, I think you need to make sure that you are giving yourself time, because that is going to be your best friend when you're doing any sort of retirement planning. So we kind of do a high level thing. I look at the time that people put into retirement. I kind of tell you how many times I've talked to people who come in their 50s and they say, it's right around the corner, retirement is coming up, and I need to start looking at how I can retire. And you'll ask them, what have they done to do that? And they might have an occasional 401k, but the answer generally is they've done very little. And so one of the best pieces of advice that I can give today is begin retirement planning immediately. Start now. And we'll talk a little bit about that. But the first, one of the questions that I get more often than anybody else or any others is, how much do I need to retire? And that is generally a loaded question, as well as very different for everybody. I know there are a lot of calculations and talking heads that give dollar amounts, but the truth of it is that if you just tell everybody you need to have $2 million to retire, that does not take into account personal needs, as well as the circumstances surrounding each of you individually. You may inherit money, you may buy and sell homes or businesses over time, you may have health concerns, you may be very healthy, your goals in retirement might be to travel or to spend time with family. And so the answer is that that's very subjective based on a lot of different parameters. What you can do right now to begin is, rather than worrying about how much to retire, is begin on when to start. And I would tell you that that is going to be right away. When I go through and look at what are some of the reasons why we might want to begin focusing on that immediately, is because waiting is a serious consequence. On this slide, you can see here that if somebody takes $3,000 a year, which is about $250 a month, and I know this slide shows that you can do that at the beginning of each year, but you can also do it monthly, which is dollar cost averaging, which is actually my preferred method if you were doing something like this. But you can see the cost of waiting. If you go through and begin at age 20, you can see there's a significant difference in the earnings potential in any type of investment versus waiting until you're in your 40s to say, all right, now I need to start paying attention. That is a significant amount of earning power that you give up by saying, I'll do it when I have the chance. And so I would invite you to consider ways to begin looking at retirement. And I will tell you what I tell everybody else, and that is begin as soon as possible with whatever you can. It may not be the $3,000 a year. If you can do $100 a month, then do it, because anything that you can put aside into retirement dollars now and begin growing will make more sense over time. And for longevity, and I said earlier that time is our best friend. Listen, there are going to be times, and we're just barely had gone through a very serious decline in the market. And most people will say, oh, I need to stop and I don't want to invest right now because everything is so crazy. And I tell people, imagine your favorite place to shop and you walk in there and everything is 30% off. You're going to unload your wallet a little bit, and hopefully Kyle will want you to use a loan or a credit card, but you're going to go buy things on sale. And so when the market is down, good investment companies and good investments are on sale. We shouldn't be stopping investing when things are going down. We should actually be hopefully increasing or staying consistent with our contributions and our investments. But the best answer is make sure that you start now and do whatever you can. Now, so talk a little bit about how we begin retiring. Want to just show the next slide here. And what are the first steps that you're going to take? First, you need to have some goals and some plans put in place. I'll bet a lot of people on this call today have made business plans and have gone through a lot of time and effort to put together plans either for their year or every other year. You're going to want to do the same for your retirement. What are your goals? And just to say, I want to retire, in my opinion, is not the best goal you can set. You need to be talking about what are your goals in retirement. Like I said earlier, is it travel? Is it time with family? Is it charity work? And do you have enough income to provide? All of those scenarios are going to determine really what your goals are. And when you go through, you're going to have some short-term goals, liquid money, and long-term and medium-term. And I like what Kyle said about having a spending plan. I do call it a budget, and I do want to have some emergency monies there, because when you're investing, they are rarely, if ever, liquid, meaning they shouldn't be treated like a savings account. You want to be able to have emergency dollars set aside that you can tap into before you do any investing, because investing typically involves some sort of risk. And you want to make sure that you have the capacity and the ability to do that without hurting yourself or without having to dip into an investment and keep buying and selling based on circumstances. So build up a really good reserve, your emergency fund, and Kyle called that paying yourself. And I call that my emergency fund. This is different than just regular savings and regular checking and operating expenses. It's a little bit of money in the hole that if you need it, you can tap into before having to liquidate any other types of accounts. Take advantage of employers' 401ks if you have them right now. In my opinion, this is free money. If you have a 401k sponsored by an employer, please make sure you are maximizing at least what they are able to contribute on your behalf and match, because this is money that they are willing to put in for you that does not come out of your pocket, and is the best way to start a retirement program, in my opinion. Make sure you're taking advantage of a match. Now, if you're an employer or you are self-employed and you do not have a 401k that you can get matching out of, there are other retirement vehicles that you can use. Retirement accounts, either a traditional IRA through contributions, Roth IRA, or even if you are a business owner, SEP IRAs and simple retirement programs and 401ks that you can establish that even allow you to add more dollars than regular contribution limits. So I would say if you don't have a 401k that you can begin using for matching, look for a way to establish a retirement plan personally, either for you or for your business. And this will be the best thing you can do to start getting a jump on retirement planning. Next, it's making sure that we choose the appropriate and right investments. And so my last slide just talks about some of the basics as far as retirement planning and investments. And without making recommendations specifically, please remember that you should try to make your retirement investments complement one another. For example, if you might have a 401k and an IRA off to the side, it might not be wise to have all of those dollars in a very aggressive portfolio. You might have one invested in something different or with a different risk tolerance. And you will want to know what your risk tolerance is. Every investment is different and everybody has a different idea of what risk means to them. So make sure that you are talking with somebody about what your risk tolerance is. Remember that time is your friend, and also please remember that life insurance is an investment. It is an investment in protection and a way to protect your business or your loved ones or a mortgage. And if you had something happen to you, and as Kyle talked about, stubbing your toe, what are the ways in which you protect your family and your businesses? And so using life insurance as a way to do that is a wonderful way, and one of the 6 key important needs in my mind of protecting an investment portfolio as well as your long-term retirement plans. Don't put all your eggs in one basket. That, of course, comes to diversification and making sure that things are spread out. And then being consistent. Again, as I talked about earlier, if the market is falling, then things are on sale, and it's the best opportunity to stay consistent in a retirement plan and a contribution program. This really gives you the best opportunity to position dollars long term, but stick to it and make sure that you are talking to somebody as your circumstances change, because investments do change. And my last piece of advice is to make sure that as you are building a retirement plan, please talk to a professional who can educate you. Be educated. Don't turn it over to somebody who's just going to say, well, I'll take care of that and I'll let you know how it works out. Education is the best part. And in my opinion, when I'm working with somebody, I want to make sure they're just as educated as possible, because it means that any investment decision that we make, we'll both know what we're doing and we can answer questions. And it also makes it so that by education, we pick the right investments for risk tolerance, time horizon, and investment experience. So these are some of my basic high-level retirement planning suggestions, and I hope that's helped. If you have any question, please let me know, and I will turn the time over now to Sean. Thank you.
Hey everyone, Sean Dunn, Director's Mortgage here, residential mortgage specialist, and I would say the reason I don't do slides is so that people take notes. However, if you've noticed what interest rates are lately, our industry is absolutely slammed. So I'm excited to share this information with you, but without any slides today. So take some notes if you can. And then, yeah, any questions in the chat box is always a great option. I see one that we'll come back to here as soon as I'm done with this section. So my kind of idea about this was to try to get into a little detail, but then also just some high level things. So the first thing I wanted to start with is just the biggest question of all, which is, is it a good time to buy? When's a good time to buy? What's the strategy behind timing that? And I always tell people, do you like the house? Do you like the payment? Then that's a good time to buy. I've seen people think and plan themselves into oblivion. So I think, you can only quote unquote time the market to an extent. The timing, I always try to push back on that thought process a little bit and say, do you like the house? Do you like the payment? Is it a good time for you to buy? Then it's a good time to buy, in my opinion. You can only win by getting off the sideline. And that's very true in real estate, which is you just, buy when it feels right for you, when you have that stability. I think that from a perspective, and this is a bit of an opinion, that the Bend market only has up to go. Of course, it's just a prediction, but I can tell you in my industry, we are seeing a massive amount of, so Bend, I'll take one step back, already has the highest per capita remote workers in the entire country. So 13% of Bend works remote. That number will only be higher when the 2020 census comes in. And then, of course, is only going to grow. So I think owning real estate in Bend in Central Oregon is an excellent investment. And I think it only has up to go personally. And then on the flip side of the housing market, also there's interest rates and what those are always doing. Like I mentioned, I don't know if you've seen anything on the news, but they are wildly low right now. They're definitely artificially suppressed by COVID and the current uncertainty in the economy. So I'd say, if you talk to any lender friend that you may have across the board, we're seeing rates for almost every product in the 2s right now, which anything under 3, we just went under 3% on a 30-year loan average for the first time in history. So that kind of says how wildly low they are right now. So if you own a house and you haven't run the numbers on a refinance, now is definitely the time. So that's step one for those that already own. It's worth running the numbers. I will say rates have been good for the last 4 or 5 years. So there are a lot of people out there that have great rates and they haven't dipped low enough that really a refi makes sense because it is pretty expensive. But there are also a lot of people where it is saving a lot of money. And then if you are looking to buy, now's a great time. So I ran some scenarios so you could get an idea of, one question I get a lot is, to what extent does interest rate impact payment? So just from a high level, if you had a $350,000 loan at 2.75, then the principal and interest payment would be $1,430. If it went up a full percent to 3.75, it would go to $1,621. So, and then let's go up one more percent to 4.75, it would go to $1,826. That's just the principal and interest portion. So it's not the full mortgage payment that would include taxes and insurance. But the idea is on a $350,000 loan, 1% in interest is about $200 a month. So that's kind of your just kind of ballpark for an average loan amount of $350. So that kind of gives you an idea on some numbers. And then let's dive just a little bit into different loan products and what we look for when we qualify someone, so you have an idea. Of course, everyone's situations are so dependent on specific scenarios, but there are, generally speaking, 4 different loan products that people fit into. So one is conventional. Conventional is we like to see credit scores 700, maybe 720 and above. That's where that really starts to make sense. The minimum down payment on conventional, if you're a first-time home buyer, which means you haven't owned a home in the last 3 years, is 3%. So there's my favorite myth right out of the gate. 3% is the minimum down payment for a first-time home buyer on a conventional loan. Oftentimes, that's a much more achievable number than the 5, 10, 20% that you hear about. So 3% down. That 3% could come entirely from a gift from a family member, for example. If grandpa wants to help you, it can be a mix. You can really get pretty creative in where that money comes from. So 3% mid to high credit scores for conventional loan. FHA is the other major one. It's the Federal Housing Administration. They're much more flexible when it comes to credit scores and things like that. So really, FHA can go down to about 620. Pre-COVID, we would even be able to do home loans down to about 580. But really, I tell people to set the benchmark. You really want to see a 620 to make sure you're getting an affordable interest rate and not realizing some penalties from that. So down to about a 620 with an FHA loan, the minimum down payment is 3.5%. So just a hair higher. And that's a very common loan. I used it when I bought my first 2 houses. There are some pros and cons to FHA versus conventional. And if you're kind of taking that next step, a lender can definitely explain those to you. Number 3 of 4 is USDA. In Central Oregon, this one doesn't get enough credit, in my opinion. It is the United States Department of Agriculture home loan. They are really encouraging and trying to build communities in rural areas. What I found interesting when I moved to Bend is that the only place in Central Oregon you can't use a USDA loan is Bend. And what caught me off guard is that you can use it in Redmond, which is a pretty big town, in my opinion, to still qualify for a USDA loan. The number 1 perk of a USDA loan, 100% financing. So they do not require a down payment. It is 100% financing. Interest rates are still great on that product. Again, they're really trying to spur and encourage economic development in those rural towns. The one catch to USDA is they have an income limit. So the income limit in Central Oregon for a standard family of 4 is right around $100,000 a year. It goes up if you have more family members, but they do have an income limit. So if you make under $100,000, you're looking in Redmond or Madras or Pine anyways, then USDA would definitely be a product that may be a great fit for you, and it's 100% financing. The last one is VA. And of course, that's a veteran loan. For those veterans out there, if you don't own a home, if you haven't game planned what using your VA eligibility would look like, you've earned it. Thank you for your service. And it by far is the best loan. So use it. It's a great loan and you deserve it. And any lender, it's a federal loan, so any lender should be able to provide a VA loan for you. It's 100% financing. There's absolutely no monthly mortgage insurance. Interest rates are typically great. So definitely, if you're a veteran, you've earned it. Talk with a lender about game planning, what that would look like. So then the next sort of nuts and bolts part is what do we look at when we qualify someone to buy in the mortgage industry? And we'll use round numbers, although they're probably a little smaller than they really would be. But let's say you make $4,000 gross a month. So everything in the mortgage industry is monthly debt to income ratio driven. So if you make $4,000 gross a month and the mortgage payment's going to be $1,000, easy, 25% is what the payment will be to your income. The mortgage world, we like to see that number be around, the 20% or the 30%. That one doesn't have a real hard line in the sand. It's just number 1 that we look at. Number 2 is the much more important number. And this is where a lot of strategy and credit report comes into play, which is your total debt to income ratio. So we're going to say, okay, you have a proposed mortgage payment of $1,000, you have a $250 car payment and $250 student loan payment. So your total out of your total credit report is the $1,500, and we're going to say what percent of your income is that. So that number is the one we care about most. I always find it, I think it may catch people a little by surprise. We don't look at utility bills. We don't look at what you're putting in your 401k. It's all gross income and credit report debt. So credit cards, car payments, and student loans are your main items to look at when looking at that. And then when people are so the total debt to income ratio for most loans is around 50%. FHA is a little more flexible, conventional is a little more strict, but that total debt to income ratio we want to see at or below the 50% mark. So I tell you that so you can get kind of an idea if anyone's looking to see kind of generally where they're at. You can run some rough numbers for yourself. Now, I find that oftentimes the strategy portion of my industry goes as a skipped part of the process. So I really, more than anything on my end, want to encourage you to chat with a lender and just, I call it knowledge is power. There should be no charge, there should be no fee to the strategy portion of getting set up. I've had clients that I've worked with pulled credit so that we could help them repair credit maybe, or look at what, for example, they should really focus on paying this credit card off, not this one. And they thought it was this one. And the reason is this one has a higher interest rate and minimum payment or things like that. So there's a lot of strategy, even if you're not ready to buy today, that I think people don't give credit for talking to a lender. Even if buying a house is in a 1 or a 2, even a 3-year game plan, chat with someone. It should be free to chat with a lender. You definitely don't need to know or have all your ducks in a row to apply. My industry loves to use the word apply, but it really is just an information gathering step. So if you're interested, knowledge is power. Find a lender to chat with, and kind of look towards, what do you actually need to buy a house based on the purchase prices you're looking at? What do closing costs look like? What's the total amount of money you'll need? Where's your credit score at? And then, of course, the strategy behind paying off any debt. Another common question is what does down payment assistance look like? Because the number one hurdle for millennials in any survey ever is always down payment. Pre-COVID and post-COVID, like everything in the world, that answer has changed a little bit. Things like down payment assistance programs typically take a step back in an uncertain economy. So a lot of them have shuttered down and stopped at this point. There are a few still. I have access, for example, to one. It's an FHA loan, and they will give you the entire 3.5% down payment, which is awesome. There's definitely no such thing as a free lunch. The interest rate is a decent amount higher. So your monthly payment is higher. They have some income limits and things like that, credit score minimums, but they do exist. And again, I think the further COVID goes behind us, the more the economy normalizes, that we will see some of those come back out. But they do exist in there. Another common question I get, I just kind of put down some general ones, is how long is a pre-approval good for? A pre-approval is good for as long as you don't change anything, or even better if you change something for the positive. So like I was getting to earlier, I've had some clients that have been pre-approved honestly for years while they worked on building credit scores up, or while they saved money, or even just as they casually shopped. They might have been really picky. As long as you don't go buy a new boat or get a new job, then really a pre-approval letter or a pre-approval doesn't expire. So it's just another reason I encourage people to get in the door, connected with a lender, and start the game planning process, even if you're not planning on buying for a while, because that way the numbers, and your pre-approval ultimately is good for as long as you don't change anything. And then, my last note on here was how ready do I have to be to take that step? I think I addressed that one a little bit earlier, but you really don't have to be ready at all. If it's just something that you are curious about or is in your future plan for the coming years, find someone to chat with and and make sure you know those numbers. So that's all that I had. I think we are 1 minute until we have 15 minutes left. I see one question here, so we'll kind of move into a Q&A. We have 15 minutes, and feel free to put in the chat box if you have any questions. Hannah and I will help kind of make sure it gets to the person. We can all answer certain ones. We'll kind of bounce it around. So I saw one just before I took over that was for JC. Let's see where to go. From Bob, he said, is there a chance you can talk about the differences in term versus whole life insurance? That's great. That's one I hear a lot. What is this whole life insurance people are talking about?
Yeah, great question. So, and kind of use some of the terminology in the mortgage world. We call this rent versus buy. A term life insurance policy is by definition a term, usually short, somewhere between 10, 15, 20, or 30 years. And at the end of each term, it's likely that premium will increase because you are now older, and to qualify for the same death benefit, you may have health concerns, or just the very fact that you're older and have less time to live means the insurance company is going to charge you more for that same premium, or for that same death benefit. A whole life policy, by definition, lasts your whole life. The premium will stay the same. It is a level premium. And the death benefit, it can build some cash value that can be added to the death benefit. And some of them will allow you to borrow against that cash value. And of course, a term policy does not have any cash value. So slightly different, just something that's temporary, but in some ways very good. A term insurance policy, if you're trying to protect a mortgage, that same $300,000 mortgage you just put up would cost you significantly less now over the life of that loan to put that in place on a 30-year term. And then if you have some other assets and retirement dollars, now you know that house is paid off, or the business if you're trying to maybe compensate a partner or something like that. So life insurance really is estate planning as well as business planning as well as debt planning. So whole life versus term, a lot of different differences, but that's the basics.
Perfect. Kyle, we got one for you, and I might tap in a little on this as well, and then I'll look at Kristen's next. But let's see here. Why do some credit checks affect your score? Why do some not? What is the inquiry process like?
Yeah, so there are two different types of credit checks. One is a soft inquiry, which is those types of marketing inquiries. The reporting agencies will sell marketing lists for people that have certain scores if they're looking for auto buyers or something like that. Those don't impact your score. What the hard applications, the hard credit checks, are the ones where you actually apply for credit. If you go into a car dealership, or you apply for a credit card, or you apply for a whole bunch of credit cards, those are the ones that go against your onto your credit report and affect your score. The reason why they impact your score is because it shows that you're going around and you're trying to open up a whole bunch of credit lines at once. So the algorithm becomes suspicious of, why do you need all this credit at once, and why are you borrowing all of this money, and we don't have any real record or showing how you're paying all of this back at this point. So that's really, I hope that explains it. It's just a matter of doing too many things at once. And I would, if you're going to go purchase a car, I would say make sure you are ready to buy the car before you apply for the loan through the dealer. It's just a thing you don't want to do a lot of.
Yeah, I have one tidbit to add on to that. People get pretty nervous of all the credit inquiries, and I'll find that it holds them back from the home process. So one thing that the algorithm that we all look up to in the clouds, I don't know. One thing that it notes that I'll let everyone know is that if you get 2 or 3 mortgage inquiries within a 15, 30-day window, it knows that you're not inherently trying to buy 2 or 3 houses, like you could open 2 or 3 credit cards. So if you're getting ready to buy a house and you want to check with 2 or 3 lenders, you're good. You'll see all the inquiries on there, but they get combined into one as to how it impacts your score. So if you are in the mortgage shopping process or anything like that, don't hesitate. You will see them on there, but they get combined into one when it comes to how they reflect against you in that sense. And then the other one that I kind of segue off of that is there are different algorithms for a mortgage pull, a car pull, a credit card pull, a self pull like Credit Karma. So I use Credit Karma myself, just more like a monitoring tool to see if it's going up or down, if there was an inquiry that I didn't authorize. So that's how I use it. But that score is not the score that came through when I pulled my credit for my refi. My score went for my refi was actually a little better. I've seen sometimes Credit Karma and I pull clients and it's a little worse. So it's a great tool, it's a great ballpark, but it will be a little different, and don't be surprised by that when you make that step. So let's see, I have one in the home buying world, and then we'll go back to JC with a retirement one that I'm curious about myself. So one, if I apply for refinance, but it takes a long time to process the application, will I lose out on today's good rates if the rates go up in the meantime? Excellent question, especially as the mortgage industry is seeing 4 or 5 times normal volume. Loans are just taking longer than they ever have before. So if you see a rate today, I actually have a few of these phone calls to make after this. If you like the rate, if you like the numbers, you can do what's called lock or float. Most clients, when they see the number, they see the plan and they like it, they lock in that interest rate for something between maybe 45 or 60 days. And that means that if rates do anything, if they skyrocket, if they trickle up, if they do anything during the underwriting process, you are locked in, you get that rate at closing. Same when you're buying a house. When you get into contract on a home, you can lock in your rate that day so that while it takes 30 to 45 days to close, your mortgage payment's not going up or anything like that. Now it does mean if they go down, you locked in. So some lenders may have opportunities to share that market trend with you, but it is something you have to be prepared for. So you're either a gambler and you're riding the waves and seeing if they go up or down, or you're not and you just want to sleep at night, you can lock in that rate right up front, and then you're good through closing. So that's that one. And then Jamie asked, and JC, this will be in your ballpark, if I'm already contributing to my work's 401k, I assume using all of the match percentage, because that's always a great thing to do. Should I also start a Roth IRA?
Yeah, great question. And the answer is maybe. So let me qualify that. Anytime you have the chance to put into the 401k and a Roth, I would start with the 401k. Right. Remember that you're going to get some employer match likely, and hopefully, and your expenses are probably going to be lower in a plan that's shared across all employees. And so, yes, I would start with the 401k. And even more so nowadays, some 401ks actually offer a Roth component. So the idea is that the Roth is tax-free and a regular or traditional 401k is taxable. So I would say if you have the ability to do a Roth 401k and add to that through your employer, I would start there. And if you have maximized your contributions to the 401k and taken advantage of all the matching, and you want to do something different that is tax-free, then yes, I would add a Roth IRA on top of the 401k. And of course, just being careful, and the advisor and your CPA will help with this, of contribution limits and making sure that we're not overstepping any of those to incur some penalties. But absolutely, I think it would always be a good idea to at least have both for both contribution and diversification, as well as different tax strategies. So something to look at. And again, that is a general recommendation. Talk to an advisor for something more specific to your situation. But generally speaking, great idea.
Yeah, plug for CPA who is not on this, but I always advise when people buy a house or when they're really strategizing intently on their retirement, it's a great time to also add a CPA to your sphere, because there's a lot of strategy that you can make or break with. So plug to CPAs, I guess. I've got a good one in my realm. Can you explain how house buying works with a spouse? Do you apply for the loan together? Does only the person with the better score apply? Great question. In the mortgage world, if a husband and wife or just two people apply, we're going to pull all 3 scores for both borrowers. We're going to circle the middle score for either borrower, and we're going to use the lower of either middle score. So if one borrower makes all the money or the bulk of the money and has the higher score, there may be some incentive to just do the loan in that borrower's name. If it is, let's say, husband and wife, and we want to make sure that that should something happen to borrower 1, borrower 2 will still get the house. In Oregon, we make sure that spouses, for example, are always on the title and the deed, even if they're not on the loan. So there's still some ways to make sure we take care of you in that way, but there's definitely mortgage strategy. Another one that's pretty common that's not so much the score, but let's say one spouse, I have a situation right now. He's a dentist, he's a newer dentist, but he has a lot of student loan debt. It's a lot of schooling to become a dentist. And he's in year one of his sort of earning potential. So he's going to be making a lot more in the future, not making a ton now. And so in the sense that we were seeing how much they can get pre-approved for, it made more sense to do the loan in just the wife's name. Because in Oregon, we're not a community property state, so we don't have to use his student loans, which are in just his name, in their pre-approval process if we do the loan in just the wife's name. We'll put him on title and deed, and they'll afford more house that way. So the answer to that is actually different in Oregon than it is in California or Washington, because Oregon is not a community property state. There can be some strategy there. So, and then on the flip side to that, I also hear a lot, my credit's not so good, but I make all the money. Is there any way to add me as a cosigner in that sense? And the mortgage world is very different than the car world. In that sense, it is all or nothing. All the credit scores and all the income go in, or none at all. So if there's definitely some strategy around deciding who goes on the application, who doesn't. Do we need to work on improving this credit score so we can use this income, and vice versa? Any lender hopefully should be able to help you decide what makes the most sense. And if you apply jointly, it's not impossible to then remove someone or add someone if you apply on your own. So it's not set in stone when you apply. Silly question, there are none, I suppose. Kyle, are we all born with credit? That's a good one. I like the silly verbiage, but it's a great question.
Actually, you earn good credit or you earn bad credit, depending on how you use credit. But you really don't see that start happening until you're 18 and getting the credit built. Although we do see some small amount of fraud along that, where people have taken identities away and when people are young. So the idea is just that you really do have your credit adjusted to how you're managing your credit score and your borrowing.
I've seen people try to get pre-approved for a home. We pull their credit scores and their scores are N-A because they have never established any credit. And what a credit score is meant to tell the lender if you're good at repaying debt. So I call it the ultimate double-edged sword, because if you're such a good budgeter that you never take on any debt, the algorithm doesn't know if you're good at repaying it. And so it's not a bad score, it's just not a score. And in my world, most conventional FHA loans, they require you to have some sort of score. So establishing good credit is better than just never using credit for the purposes of buying a home, at least in my world. Establishing good credit is. Another great question, how many student loan interest rates, with many student loan interest rates being 0 right now, it's tempting to pay them off completely. If it's my oldest credit amount, will paying it off early poorly impact my average credit age? And if so, what are tips to lessen the damage?
Yeah, I don't think paying off that debt early is ever a bad idea. So I think you just really have to look at, how much you're paying and what other things you're trying to accomplish with your strategic financial plan, looking forward into the future. When you can borrow money at low rates and not pay it back, and just really the cost of borrowing is very low, then that's probably a good thing to take advantage of. And so if you have other things that you need to do, if you have student loans at nearly 0 and you're trying to pay those off, but you also haven't invested any money or haven't purchased a house or don't have a retirement plan, you may want to think about investing in those. As JC indicated, the earlier you can get into retirement plan, the better off you're going to be. And the same as with purchasing a home. If you can purchase this house, you're going to have equity in that home and building that over time as well. So I think it just is a matter of what you're trying to accomplish, where you're at, and what your current financial situation is.
Yeah, when it comes to the installment loans like cars or student loans, those ones there can be a lot more strategy around. Credit cards are just always higher interest rates. And those, generally speaking, you always just attack those first. One sort of tidbit that just came to mind, though, I always use this as an example. My parents got me a Wells Fargo credit card with a $500 limit when I turned 16 and got a car so I could pay gas. That card, I haven't even had that card in years. They haven't sent me a new one. I don't use it. I probably shredded it, but I do put Spotify on it every month, and then I have it set to auto pay, and I've completely forgotten about it. But $15 goes on, and then it gets paid to zero every month. The reason I did that is I absolutely do not want that card to be canceled due to inactivity on me, because it is my longest trade line, and it looks great every month because I charge it a little and I pay it to zero. So she kind of hinted at the end, if paying off or closing an account can hurt your score. On credit cards, I always advise pay them to zero, get them to zero, but then make sure they don't close them. It really doesn't benefit you to close an account. And especially for the ones you've had a long time, don't let them close it due to inactivity. So put a small Netflix bill on there or something.
Paying off loans is not a bad thing, but like as you indicated, the credit of closing accounts, if you have active credit lines, and I think that's the key, then those are definitely things, especially if you've had one for a long time, those help your score.
Yeah. Well, let's see. It just ticked to 1 o'clock. I know we are all busy, and I think if Hannah is still here, she has some closing remarks.
I am still here. Thanks, Sean, and thank you so much, Kyle and JC. I learned so much from all of that, one of those questions being mine. So I really appreciate you joining us, and to all of you viewing, thanks so much again for joining us for this webinar. If you want to review any of the content, you will receive it in a follow-up email, and you can watch the recording. Thanks again to everyone, and I hope you have a great rest of your day.
Thanks.